that you go, okay, time to duck and run.
Yeah.
Right. Yep.
So I have like 7 questions here. We haven't even got to one of them.
Sorry, man.
No, I love this. I can listen to this all day.
Listen, we're still under 30 minutes.
Stuff, because that was not the intent of this. So no more talking about our products.
No, we're still going to talk about your product. We're not plugging
left and right.
We're not plugging anything. We've mentioned Robinhood. We've mentioned the airlines. So we keep those people happy. The number one question I think I get the most is, how can you be so smart and so good looking at the same time? No, the number one question.
I never got that before.
The number one question.
He was talking to me.
On position size. I say the most common question I get is on position size. People want to know okay, XYZ stock, Tom, it's setting up on your list, or I like something, I post a chart. What should I go in, like 2% of my account, 5%, 10? Like, what is a guideline so someone can use, and the number of stocks they should be holding?
That's a huge thing. Irusha, why don't you take it first, because we do that differently now.
Yeah, well, I'll go from the traditional kind of can slim, and so with the traditional, the ideal kind of portfolio that you want to eventually get to is 5 stocks, right? You have 20% in each stock. Now, at the beginning of a bull market, you just don't pick 5 stocks and these are my 5 stocks and good luck. A lot of times, from my experience, I'll start out like with 10 stocks or maybe 12 stocks even, because there are numbers starting to set up, and then one by one they start to go maybe in the first few weeks. So you're ideally putting 10% positions in each of them, and then you let the market tell you what to do. So if you have 10% in 10 stocks, 5 of them are probably going to go sideways or start selling off, or maybe even more than that. A few of them will work immediately, and you're going to be up on them, and that's where you're going to start pyramiding into. You want to start force feeding into those best ones, because the market's saying, hey, you want to put more money because those ones are actually working. Others are agreeing with you on that, and that's how it's pushing up the market.
So you would drop one of those 10 and then make one a 20% position.
Yeah, well, I mean, like 3 or 4 are going to fail probably pretty quickly. Yeah. So they make it easy. They're going to force you out, right? If you're respecting stop losses, things like that, they're going to force you out. The hard ones, and kind of like AMD, AMD's been a hard one, because it's like NVIDIA and AMD both kind of out of this recent rally, they both started working, and I had both of them. Then all of a sudden, AMD just stopped doing, just didn't do anything, right? NVIDIA is acting like a leader still, and eventually AMD just wore me out, and I just had to cut and run, even though from a larger perspective, it was still fine, but I had to free that money up to put in his other stocks that were working. So you're kind of letting the market tell you what to do, but if the rally lasts long enough, now you have the chance to build it into 20% positions. Okay. So that's kind of the traditional way. Mike, you can kind of explain another way, or how Leaderboard does it too.
Well, look, there's lots of ways to do it. This is a great question, and I think really the best way to do it is how you feel comfortable as a person. And there was a time where I felt comfortable doing it differently, and really being around Bill so much, anyone who knows his story, he made his money in focusing in on one stock and being 200% long that stock, like full margin for a move. And there's no one that can pick stocks like him. Irusha can't do it. I can't do it. I guarantee you two can't do it. I've never met another person that could do it the way he could. So he could get away with that. And he didn't just put it all in at once. He would do it slowly over time. And he would always, I shared an office with him for a couple of years. And many times I'd hear him, say, buy me 100 shares. And I'm thinking, why are you buying 100 shares? Like, you got your account's this big. But it was just gradual little bits along the way, always on up days, never on down days. And so all of us at the firm, we kind of got that was our, goal, to try to be like Bill. And, back in the 04 to 06 timeframe, we would all pile into basically 2 names. And when Apple and Google,
Hansen and Taser.
No, I wish Taser. That's a story for a different day. But okay. It was Apple and Google. and all of us would have like, I had like 80% of the account in Google and 120% in Apple, and we lived to see the end of that without blowing up. But every night I went home thinking, geez, Steve Jobs is going to go down in a plane accident. Like what, what type of risk am I taking? So now I've kind of gone the other way. And now I'm like an accordion, and I look at 3 different things. How is the market doing, and try to grade it, A to C or A to F. How am I doing, A to F, and how is the stock that I'm looking at A to F? And so that will, if they're all A's, then I might, do it one way. And if it's all C's, I'm going to do it a different way. So I'm an accordion. I'll have 30, 40 stocks sometimes. I'll have 8 stocks. And it just depends on how I'm doing. If I'm in sync, I want bigger positions. If I'm out of sync, I will have more positions because I'm just reducing my risk that way. That is not the way Bill would ever operate, and that's not within his guidelines. That's way off the reservation, but I feel comfortable with it. So
I think that methodology and that thought process is a lot more consistent with the everyday man that's trying to do this, though, because Bill was unique, super unique, which you've pointed out, and there are so many different factors that are playing into what we do, into how we feel as people. I do the same thing. It sways my position sizing actually more than the number of stocks that I'm handling and whatever, in terms of whether I feel like I'm in sync or I'm not in sync and different things like that. So I think that's helpful because so many people have, Joe, you and I were just talking about it earlier today, about trying to get our head around how exactly did Bill do this. And I think a lot of it is just,
he's a genius.
He's a genius, and his unique personality and his profile, his makeup allowed him to be able to trade like that.
Well, and also think
like
about,
I couldn't do that. There's no way I could do that. It's just, you have to tailor it to what lets you sleep at night.
Yeah, and also think for Bill O'Neill, no one has studied growth stocks more than Bill O'Neill in the history of the stock market. That was his obsession for 50 plus years, right? And it's so obsessed that he developed all these tools to help him analyze the stocks even better. All these tools that were created to help him analyze the stocks. It wasn't necessary. And then it's like, oh, this is cool. Let's provide it for customers and all that stuff. But yeah, so if you've studied it that much, yeah, in my opinion, you've earned the right to, that is the leading stock in the market. I'm going to slowly, even then, he's still slowly built into a large position. If the market kept saying put more money in, it's just the listening of the market. That's really the biggest.
A lot of people have asked me this question, and I don't know the answer. They say, okay, you look in the beginning of the book, How to Make Money in Stocks, and it shows you these monster winners, 500, 1,000%. And they get the illusion of that's what they have to try to do, or that's what O'Neill did. And then another part of the book says, buy 3 stocks. If you make 20% on one, stop yourself out at 7 on the other 2, you make money. So the question they ask me is, what should I be doing? Should I be going for that swing, 20% gain, 7% loss, or should I be putting more in and going for those home runs? And I tell them do whatever works for you, because I don't know, but do you get that? Like people asking,
all the time.
Like, did he really put a whole bunch of money in 2 stocks and that's it? Or, did he take profits at 20% and stuff?
He did it both ways, and it would depend. He was always searching for the best stock. And I remember the first time witnessing him getting really gung-ho in a stock, and it was Corning. And it was after the market topped in March of 2000. And if you guys remember, we had that rally that was like probably
July,
May,
August.
May, June. Yeah. That, and it was ripping up. And even though we all probably thought, okay, this is a bubble that's burst, there were a lot of stocks that still looked good, and they were still trying to keep the Dow up and the S&P up so they could dump all their stocks like we talked about. So Corning was had changed their business model, and they were fiber and all this stuff, and he was gung-ho. He was all in it. But what happened is, so I don't know how much he had, but I would guess it was over 100%. As soon as the stock started faltering, he got out. So we could fall in love, or he could fall in love with the stock, but have a, kind of a line in the sand there for that one, and then go on to trading more 20% gains, in 2003, at the, at the beginning. But he also was building eBay in 2002, and that built into a big position. So he had this monster position in eBay, and so he would just take little trades on other ones as he's piling in over time.
So yeah, but the direct answer is he does a little bit of both then? He does a little bit of short-term and long-term?
A lot of long-term, some short-term, to really find what that right one was. So you got to kiss a lot of frogs type of thing, so he has this feel for, what is that true leader? The way I approach it is a blended approach. I do swing trading and I do position trading, and because there's something to be said for swing trading of just locking it in and moving to the next one, and I like that.
Which is how I always did it. I mean, your swing service that you're in charge of was very similar to the way that I used to trade my swing stocks all the time. Capture the explosion, get out, move on. Yeah. Just keep cycling your money through explosion when the market was hot.
Yeah, and
keep the money moving.
Yeah,
I made a cut off for Irusha. He was going to say something.
Yeah, I'm sorry.
No, it's about big winners. You were going to say add to how he trades.
Well, yeah, because people like even in seminars, people would ask Bill this question, and I think the best answer that I've heard, or that made the most sense for most people, is for every big winning stock that you have, you should have taken 3 other stocks at 20% gains, meaning take most of your gains at 20% when you have them, lock in your gains when you can, because not every stock is going to be a big winner. When you start this, every stock I bought, I thought was going to be a big winner. Wow, it came through the IBD screens. It's breaking out of a cup with a handle, right? Yeah, exactly.
Yeah.
And then it would go up 20-something%, 30%, and then go all the way back or whatever. So it took me years, but I learned the hard way. I like to take those profits into strength. But if I really like a stock, I'm going to hold some of it. So if I'm up 20-something% and I think this could be a game-changing stock, I might sell a third of it or maybe a half of it, and then I'll hold that core position. Yeah, and if it pulls back, now I can add back to it. But then it's on my radar. A lot of stocks, I'm locking those gains too.
Okay. This other question I have is, Tom and I have talked about this before, is we've noticed that breakouts used to happen on no news a lot more frequently than now. And what I mean was, I don't know, the bulk of my trading, like, let's just say whatever, 98 to even up to 2010, maybe 2015, I would screen and I would trade, and out of nowhere, stocks A, B, and C would break out on the day, and you'd get these explosive moves on no news.
With huge volume.
Volume. Like a nice 3 to 5 day, 10 to 20% pop. And then my friend is screening. I'm trading A, B, and C. He's trading D, E, and F. He's like, oh, did you see these? And I was like, oh, I didn't even see them. He would trade 3 others that break out. And then on my list on my screens, it'd be X, Y, and Z. I'm like, oh, geez, I didn't even see these popping. So they'd be happening all over the place. And correct me if I'm wrong, my observations are either earnings are causing these breakouts or they're not doing what they used to do as far as tape reading. Have you noticed that?
Well, it's Reg FD, and we talk about it a lot. Irusha and I talk about it a lot. Is that unintended consequence of the government stepping in and trying to help a situation. So, if you step back from what chart reading is chart reading is just interpreting, the fear, greed, and hope, right? That's what we do. That's what the 4 of us do. We're trying to say, who's freaking out and who's getting greedy, and you're looking at the chart for those clues. Well, back in the day, the big funds would get a wink and a nod from the CEO and the CFO of, hey, we're going to hit our numbers. We're not going to hit our numbers. So our job was just to read into that and read into the chart. And so it would act naturally. And that's another reason why I'm spreading out more, is because before you could read it in the chart, we didn't have gap downs back in the 90s. It was very rare to have that, or even, until really Reg FD was really, moving. And now 4 times a year, the companies give this information, all the analysts put in their little spreadsheets of this is what it's worth now, and it immediately tags up to that level or down to that level, and it puts all of us in a position of, well, in between those 13-week time frames, we really have to do our work because that information isn't out there. That's my take, Irusha.
Yeah, no, the earnings reports, earnings reactions have just become incredibly important. Every quarter, the way I look at it is this is my opportunity to bring new names on the list because the market is going to, with these extreme reactions, it's like, hey, consider these names. You might not necessarily have to buy it on the earnings gaps and all that kind of stuff, but put it on the watch list, see if it can set up something else, maybe a little bit shorter term, like a 3 weeks tight or something like that.
Yeah.
So, I mean, I think this past earnings season was probably the kindest that I've ever seen. Everything was acting well. But you had a number of them, and like Twilio, I own Twilio. Mercado Libre is one. They were all like jumping up on like one day, but there have been a ton of earnings gaps.
I want to share my screen to show you a perfect example of what I'm talking about. Like I'm pulling up ZS from just 2 weeks ago.
Yeah, Zscaler's another one. Yeah.
So Zscaler finishes, the IPO base, whatever, and then it has a handle here.
Yeah.
And it was the earnings that caused it to go from whatever, 75 to 100. What I'm saying is, in the old days, is that I felt like you could buy this. It's setting up. You buy it at 75. It pops to 78. You add more like intraday in the afternoon, and then
breaks through 80.
It would do full. This. It would do this move without the earnings, and you could get that. Stock go from 80 to 100.
Yeah. Earnings were a month away. They were the second.
There was no news. Maybe an upgrade, but no news, and this would just happen. And now I'm feeling that. And there's been flavors of this in the last 5 years, but I feel like this hasn't happened since fall of 2010 personally.
No,
but
it's been bottled up, right? I mean, because of the Reg FD, and it got more extreme because in 2010 with all this other kind of stuff that's going on.
So,
I was just going to say the move in Netflix and Amazon, it was on, what was it, April 13th or whatever, where they went 4 straight days up with huge volume. Was like a huge light bulb for me because it's like, that's the first time I've seen that kind of price action in years.
Yeah.
I can't remember what
breaking out on no news. That's what
they broke out. They exploded on no news 4 straight days. The follow through day was like on the 6th or something. This was a week later, and 2 big companies, and they both just launched.
Yeah. And that was before their earnings.
Launched, and it was like a 4-day deal. And it's like, that was for me. That was like something's different here.
They used to happen all the time. Chipotle did that in 2010, coming off that fall through day, September 1st, and it set up. It went from 100 to 240, just stair stepped and just kept breaking out and through a couple tight.
Well, because more information about their earnings report, stuff like that, how well their business was doing, was leaked out before, right? So it would just kind of filter through, especially like Boston, all the mutual fund companies and all that stuff. And so they're like, hey, buy more, right? So they were getting ahead of the earnings, which was not, for chart readers, that was beautiful. So we're all kind of screwed because of that. But you just have to adapt.
Oh, now all of Robinhood is left. They were coming back.
I have a theory that weekly options also has something to do with this.
Sure, yeah.
Where I think in the old school days, every third Friday of every month was just a regular options expiration. But my theory, which again, I don't know, it's just a stupid theory I have, is that the market makers maybe have to contain these breakouts because of the implied vol for the week or whatever. So maybe
open interest strikes and all that stuff.
Yeah, it used to be 10
stocks back because they're loaded short because they're the net sellers of all that stuff. And
they have to keep the stocks down because of that open interest. Exactly. Yeah. And that's my theory as to why, it used to be 10, 20, 40 stocks. Now every single stock, it seems like, has weeklies. So that's what's keeping this muted. It's just a theory I have. I don't know how to even test it.
That is interesting though. Yeah.
I think that makes a lot. Makes a lot of sense. And the more some people want to like restrict things like that, but the more ways that people have to play without restriction, the better off it is. It's just like every once in a while people are like, oh, when the market's coming down, don't let people short. No, I don't short, but I want people to short because it helps balance out the market, just like what you're talking about with the weeklies.
Yeah. No, that's a great point. I didn't think of the Reg FD thing. One other question I have, I'll go back to MarketSmith because this is.
I got to go in like 5 minutes, though, Joe, but I can click off and you guys can keep going.
Okay. All right. That's cool. A question I have for you guys is, okay, you look at the daily charts I pulled up the NASDAQ to count distribution days, but you guys alluded to this earlier, is looking at weekly charts to get the bigger picture. So
not for the market.
Not for the market?
Yeah.
Or for the market?
Not for the market. I mean, you still look at the weeklies for the market, but the bulk of it you do with daily.
Oh, okay. Because my question to you was, let's say last week there's a distribution day here, right? So there's a distribution day on that big volume. But then when you go to the weekly and the weekly chart shows an accumulation week, do you look at it that way or no?
Look, the distribution is not what it used to be, and volume isn't what it used to be, and especially now that you have all this, you keep alluding to Robinhood, and you've got all these, cheap stocks that have tons of number of shares traded each day, but it's not dollar volume, right? It's not the dollar volume that's moving in there, or out of there. So I don't think you can look at distribution the same way. So right now I'm in the middle of a study with a couple of buddies at work for dollar volume to use in replacement of standard volume for distribution.
Oh, interesting.
We're still working on that, because just like what you said, it's a theory. And what Bill would teach is, you have an idea, test it out, see if you're right. But I don't look at distribution the way I used to, just because the number of shares so easily manipulated, where if you look at an Amazon that's $2,500 or some piece of junk, or like GE at $8, how much money is flowing through those.
So Hertz at $1 in the last couple of weeks, and they're trading tens of millions of shares.
It's turning 100 million shares sometimes on stocks that have 10 million in.
Yeah, because we've had 3 days in a row over 6 billion shares.
Yeah,
3 days in a row over 6 billion shares on the NASDAQ. It's never happened. So maybe I see what you're saying. It might be skewed by those cheaper stocks.
And it's with stocks that have nothing to do with the indexes.
Yeah.
Correct.
It seems after 2008, 2009 that all kind of was tilted a little bit, right?
Yeah,
like
I know.
I remember 2004, 2005. It was like clockwork. You get 5-6 distribution days. Yeah, it was all stocks, leading stocks start falling apart, things like that. But I'm with Tom here. It's like you're just and the rest of you guys, leading stocks. Keep an eye on those. That's your universe. Is the environment there to reward leading stocks or not? Right. So that I mainly focus on that, and then I'll just take a quick look at the distribution days. But I don't study it as much, the overall indexes, as much as I used to. I just laser focus on the leading stocks.
I'm learning. Listening to you guys. I love this. Hercules. I love this stuff. Mike,
well,
you're going to pull up some charts.
Stock. Yeah,
go ahead.
Well, I want to see what you guys think of it.
Who cares what I think? I want to know what you're thinking.
I want to see what Tom
when you got Michael Jordan in
the
room, why are you giving me the ball? I want to.
So Irusha,
I'll be Scottie
pull
Pippen.
up any stock you want. Let's talk about it.
I'll be Scottie Pippen. That's funny.
I get screwed over by the contract.
Go ahead. You want to pull up your charts?
No. You pull up a chart. Pull up any chart you want to talk about. Let's do it, man. This is fun.
Man, there's so much pressure. I'm like sweating over here.
Tom, let's go over some of your 75 that you have.
Oh, my 75.
You want to pull up charts, or just give them to me, Tom? I don't care.
Put up
look, I've talked about 3 personally: NVIDIA, Netflix, and Amazon.
Stay right there, because NVIDIA is one of my, is right. I'm very focused on.
The reason what NVIDIA going to weekly, NVIDIA, Amazon, and Netflix were all basically in 2 to 3 year bases and came out of them. NVIDIA, coming to bring it down to the daily, right around here, got tight in this handle here. Mm-hmm. And it's a position I put on. I still own, full disclosure, and it's acting great. And the whole concept,
it's tightening up right now.
It's running. It's running up, and you got a little tight range here.
A little shakeout move, but look at if you go back, you got the last 2 quarters, triple-digit earnings growth, over 30% in sales, over 30% up in sales.
And that's why they show up on your screen.
That's why they show up on mine, and that's just like for me. Those last 2 quarters, it's everything. Now flip over to the weekly. And it won't show it for NVIDIA because it's already a well-owned stock. But if you go to where number of funds area, but it shows what I want to see. I love seeing those 4 numbers getting bigger.
Oh, right here, these 4. Yeah.
And,
I see right
preferably, I like to find stocks that aren't necessarily like NVIDIA. For the way that I used to do things was too big of a stock. It's a phenomenal stock that I consider, and I try and trade every day or as much as I can as a day trader. But I like to see, I was more into discovery stocks. So like EVER, put that one up. I don't know. I just have it written down.
Yeah.
Okay.
This one had so much accumulation on the weekly chart. This was like footprints when it was $5. Every single monster.
Okay. Now like this is what I would call a discovery stock, because look, it's like funds are just discovering it. Look, I mean, 76, 120, 193, 228. It's just a baby. 17.2 million shares out in float, only 27 million outstanding.
Yeah, it was just
these
like
guys to get stock,
a little billion market cap.
They're gonna fall over each other because you've got a company that's growing. Look at the sales growth. Like that's the stuff that gets me really excited. And then all of a sudden, if it's supported by these explosive volume moves, I'm pointing to a chart and you can't even see. That's what tells me that the thing's in play. And so that's a key stock on my list that I'm watching.
Great earnings, gap up. And then, I mean, it was like after the fall through day, held up above its 50-day and then just consolidates. One thing I've also noticed is right before stocks or the market take off, they just love to screw the weak hands and shake people out.
Yep.
Yeah.
You know, right before Brexit, and when I say just stocks and the market, so Brexit, early July of 16, we have that sort of bear market between mid 15 and mid 16. And
stealth bear market.
Stealth bear market. The SMH is setting up beautifully. And right before I'm like, oh, we're ready for a big move, you have that Brexit to just shake everybody out and then off to the races. So the analogy here was EVER. You have a little tight handle or 2-3 week consolidation. It goes down to just blow through every monkey who has to stop at the low of that range, comes all the way back up, and then
shake
just
the tree, baby.
Was that May 27th?
Looks like it.
Because that happened like in every stock. That was one of those. Mike always talks about this on IBD Live. The tells, right? The leaders gave another card out. They revealed another card showing you had all these huge upside reversals right there. And so, this is another perfect example.
That was a massive test. Let's go back to the NVIDIA, because I have a position. I think we all own it. Is one of the leaders there.
I do not own it.
Okay. Well, you're going to own it tomorrow, I know.
Correct.
You're going to trade it. So, and this was what you look for with the tells is, does a big, the EVER, I've traded that too, but it's, much thinner. So it trades different. You expect something different from an NVIDIA than an EVER. Not better or worse, just different. And so this one should respect moving averages more because there's more hands in there. Notice that green line, which is the 21-day, never a 20-day, a 21-day.
I have to cut you off because that's another question I get. People always ask me, because I just say 20. People have asked me 20 versus 21 and exponential versus simple. And what's your answer to that, please?
21 exponential. I did a big study way back when, and if you don't like it, do whatever you want. But
I don't like it. I just have to change all my damn screens right now.
No, I'm not saying you. I mean people.
No, please.
In general.
So go ahead.
I don't like it, Mike.
Because I know that's the number of.
Mike, I would never say that to you.
I know that's the number of days.
I like you, Tom. So go ahead. There's a Fibonacci thing. There's and I just tested them all out. There's not much of a difference between a 20, 21, and a 22, right? And so you kind of want to fall with a Fibonacci number if you can. There is something to that, but also when you're looking for a shorter term moving average, you want to go with exponential always because it's tighter, unless you're using a 10-day, which I don't use, but I used to, and I know a lot of people use it.
I do use the 10, and people ask me the difference between the 9 and the 10, and I was like,
9's a fib.
So
anyway, so go ahead. So,
with
21 exponential.
With the 21 exponential, One, I started using this after a big study that I did late in the 90s, and before I didn't know anyone who was using it, and we have it all in our products now because basically it's my thing. And the bottom line is that's a natural place where the indices come down and rest within our style, and it works for stocks as well. The exponential just puts more weight on the recent action. That's what you want for a moving average that other people aren't using. If you're using a 200-day, a 40-week, a 50-day, a 10-week, or 10-day, you want to use simple because you want to see what everyone else is using. And because you want to see, is it getting support where other people think it's getting support?
Because I was going to ask, do you use 50 simple? So that makes sense.
Yes.
You use simple for the 50 and 200.
Exactly. Anything.
So what do you have on your charts? What do you have on your charts? 21?
Just 21 exponential, 50, and a 200.
What about like an Adams pitchfork or like a Ichimoku cloud or all that other stuff?
Maybe so you're trying to get me to cuss is what you're. No.
Oh, I just hit a nice button here. This is great.
That's a whole nother thing. So anyways, but I do use candles, but I can't use that in our products yet. But so I use
candlesticks.
Oh yeah, always use.
Okay.
It would give me the hardest time, but we'd be up on stage and we'd get a question. What do you think about candles, Bill? And he'd be like, I don't know. Webster uses it, and then I'd have to answer the question.
You're the stepchild. He doesn't want to talk about it.
Exactly.
Yeah, over there.
He's the only one in the building who uses it. But anyways, with this, going back to the stock, notice how every time it got down to that green line, the 21-day exponential, it got support. And this last time, you had that nice upside reversal there. It's gone over here and it has been tight. The only thing I'm not crazy about is the relative strength line is coming down a little bit, but a lot better than AMD, which was coming down substantially. So that's my take on this, and I added a little bit.
This is what Irusha was talking about. AMD like exploded after the follow-through day, and then just sideways. But it did get tight. It got super tight the last few days.
Exactly.
That was my best trade of the day today.
It makes sense. Yeah. Let me show Tom one thing that he might not. Go back to NVIDIA for 1 second. Tom, you were talking about
for Christ's sake. I'm kidding.
You were talking about funds, mutual funds. If you open up the right-hand side panel, Joe, and go to ownership.
This is where Arusha's like Batman pulling out his
I don't know why.
I never
click on the owner. Click on the owners.
Why is this taking? Okay,
I don't know. You're making us look bad, Joe.
No, it's my internet connection. It's my AOL dial-up takes a while, so blame it on me.
Well, so basically, you're in the same birth year as the MarketSmith product is. You guys are both about 20 years behind.
There we go.
Fine. Not a big deal.
I love it.
One is timeless. One is timeless. I won't let you know which one it is. But
so this is the number of funds here?
You have 8 quarters, but then right below it, we added this maybe a couple of months ago. So it's not just the funds number that we're interested in. We want to know which mutual funds are buying it. And so these are part of the IBD Mutual Fund Index. And so there are 20 funds at the IBD Markets team. They select those fund managers, and Mike's already mentioned ContraFund, Will Danoff.
He's the best out there. Like
he's the best
there's just no one better than. He might not always have the best return, but he's got so much money, and he's I've never met the guy. I would love to meet him. He's a freaking genius. If you study what he owns, what he doesn't own,
I've heard,
yeah. So we look for we're looking for two or three funds in this list. So if Fidelity ContraFund's in it, that's a big plus.
I know.
Because,
what do you do with 50, 60, 80 billion anyways? I don't even know what.
I don't know.
You know what sucks is your universe.
NVIDIA.
Your universe of stocks is the S&P 100. Like I don't need to look at Magellan or ContraFund to know when I look at their top 10 holdings, it will be Apple, Amazon, ExxonMobil, Microsoft. Like no shit, I know what they are because they can't buy an EVER because if they take a position in it, they're going to own the whole company. So,
but Joe, what you do is you look at these big ones like this, and then you see, look, they all have to, whether it's consciously or subconsciously, closet index to a certain extent. Because if they don't own NVIDIA and everyone else, all their competitors do, they're essentially short it. So they have to at least be market neutral on it, right?
Good point.
So what they're, put yourself in their shoes is like, okay, that's where they're going to get their alpha. So you want to look for where is it overweight versus the S&P. That's key. And then the other thing is what do they own that's not in the S&P? Because that's what they're really reaching out, and they're taking risk if they don't own it. If their bogey is the S&P 500 and they go out to an EVER, that's saying something. They're making a statement there. If they own a bunch of Apple, NVIDIA, Microsoft, they have to, like you said.
Yeah. That's a great point, because I remember some hedge funds when Alibaba got public and it wasn't in the S&P 500 to pick up that alpha. They all plowed into it because, one, it was liquid, and two, it was a way to, have something not correlated to the S&P.
Yeah, get some juice.
And a lot of them are doing an awful lot of sector buying instead, because they can't. I mean, EV, like if you go back to if diversified, what was it, diversified insurance or something like that, they have to like the sector to get excited about a stock, because they can overweight that stock, but they can't buy enough of it for what Joe said. They have to buy the whole company for any kind of significant move in that stock to make a difference to their portfolio. So the way that they do that is that they have to pour into its competitors as well. So they're making a sector decision a lot of times more than a specific stock decision, and then they're weighting those stocks inside of a sector decision.
So
exactly.
No, that's a great point.
Yeah, which Mike, is why I study the 197 industry groups, and I want to be part of the industry
in the top sectors. Yeah,
the top 30 or 40 industry groups, and I love seeing that industry group that's climbing in rank.
Yeah,
kind of that stealth move. I love seeing that.
The question I have, if O'Neill had this like incredibly